Hey everyone, thanks for joining me today. In this video, I'm going to be talking about a new Canadian dividend stock that I just added to my stock portfolio. As you can see on the screen, that dividend stock is Dream Industrial REIT. In this video, we're going to go through a bit of background on this stock, going in their investor relations to see what this company does, what kind of tenants they have, what kind of geographies they operate in, and then looking at their valuation and their assets. So we're just going to jump right in. High level here, you can see the company has about a $4 billion market cap. They pay a nice starting yield of just over 5%. Over the last 5 years, you can see this company's actually gone up in value, where lots of Canadian REITs have been going down because of interest rates going up, because of some weakness in the office and retail sectors. But you can see here, $11 stock price in 2019, went all the way up to about $17 in 21, down to $13.50 today. So got a bit of a correction with the rest of the space, which I like to see. And I believe their net asset value, which is the worth of their assets, if you take their assets minus the liabilities on their balance sheet, is about $16, $17 a share. So also getting that nice little discount that lots of other REITs are providing in the public markets as well. So like to get that discount, even though the stock isn't down as much as some of the other REITs. It's good reasons for that, which we're going to get through here. So looking at some background on this company, over half of their value in the assets they own are distribution assets, about 30% in urban logistics, and then 15% in light industrial. I believe light industrial is just facilities that maybe smaller, medium-sized businesses will operate their production as well as their offices in the same facility. So just one building, they have some office at the front, then they produce or import the products in the back. So it's all kind of one holistic center that they operate their business out of. And what you'll see here right off the bat is the European presence. So over 50% of their distribution assets, which is over a quarter of the entire worth of the company, is in Europe. About 20% of urban logistics is in Europe, and then just about 10% of light industrial is in Europe. So you're getting a lot of European exposure, and we'll go through that more as we go along with the video. Quick peek at the type of assets they own here. Once again, we'll go into a bit more depth into that later in the video as well. Okay, so looking at some history here, the net asset value, which is the underlying worth of the shares just in the real estate that they own, you can see they've had a really, really nice increase here from about $10 a share up to $17 a share at the end of Q3. So we'll see how that transpires over time. Looks like it kind of settled over the last year and a half. But generally, I just take that as on a macro level, industrial real estate is becoming more valuable, more in demand. And I think that's a good sign fundamentally when entering this space within the real estate sector. And you are paying up a bit more. We'll go through valuations in a couple minutes. But this is a space that is a lot more recession proof, a lot more defensive. Unlike maybe retail or office where there is some structural headwinds, industrial is actually a space that's been picking up steam as more people are, buying products online and needs these kinds of distribution centers around major cities around the world. Total shareholder return has also been decent, I'll say. And I'll say it's been decent in a time where the REIT sector has underdeveloped at large because of interest rates and other dynamics. So you can see here in the last 5 years, total return on Dream Industrial has been 28%. The total S&P has been 21%, and then the REIT index has been 13%. So it's been performing over 40% higher than the total REIT index, which is actually down 13% on a total return over the last 5 years. Going into some opportunities they have, and this was just interesting to see. You can see here the dollars per square foot that they charge for their properties in Canada. They're up to about $13, $14 a square foot. In Europe, they're at about €6, which let's call it in Canadian dollars would be like $9, $9.50, something like that. So about a 40% difference in the cost to lease per square foot. I think that's a bit as a result of lots of their facilities being in and around Toronto, Montreal, which are some huge cities, right? So I think the dollar per square foot in those areas are probably driving up the average in Canada, whereas Europe, they may not be around as mega cities as something like Toronto, where real estate's super expensive and access to that population will cost you a pretty penny in terms of a distribution centers on the outskirts of the city. Nonetheless, both are having really nice growth. You can see in Canada, 18% growth, led by 22% in Ontario. Once again, that's probably mostly Toronto. And then in Europe, they also had 7-8% growth. So that's not too shabby on its own. Looking at some of the interest rate variances between the company from where it was just 4 or 5 years ago, I think they made a more deliberate choice to break into Europe, and that's really helped them refinance and leverage the lower interest rate environment there versus in North America. So you can see here, over the last 4 or 5 years, lots of REITs have been really challenged with their interest rate, debt servicing costs. What really shocked me on Dream Industrial is their interest rate has actually gone down. You can see here, they used to have 35% of their debt in North America, and then the rest of it in equity and euro equivalent debt. Now, or actually they didn't have any euro equivalent debt in 2019. Now over a quarter of their debt is euro equivalent debt. Only 7% is North American. The rest is equity. So that's kind of just owned outright, like they don't have debt on it. So they went from being 100% North American debt to just 7 out of 35% North American debt. Huge shift. And that lowered their interest rate from 3.6% to 2.3%. Having a 2.3% weighted interest rate in this environment is a huge advantage. They're probably cash flowing significantly more than competitors that are in North America with 5, 6, 7% interest rates. So I don't know how sustainable this is. This actually concerns me to some degree because I'm assuming this 2.3%, maybe some of it's on fixed terms, may correct up to 4 or 5% over time, and that may have a funds from operation headwind long term. The other thing that I just wanted to take a look at was their mix. So you can see their use of space, over 70% is for distribution and warehousing purposes. And then light industrial, we talked a bit about earlier. Combine those two, it's about 90% of their annualized rent. Then their 5% office space, that's usually attached to these centers. 1% cold storage, 4% other. So like 90% of the business is really light industrial paired with distribution and warehousing. In terms of their exposure by sector, 20% logistics, no surprise there. These consumer and food and beverage aspects of their mix is probably people distributing products like wholesalers and whatnot, or maybe small businesses or medium-sized businesses making consumer goods in the back, like light industrial, and then having their office up front. But overall, I like their mix. Unlike a retail REIT or something like that, you don't get the exposure to like movie theaters or other sectors of the economy that may be under a lot of stress in the next few years. They're pretty well diversified across pretty stable industries here, I'd say, for the most part. Tenant size is interesting. Over 50% of their tenants have over 100,000 square feet, which is massive. So lots of these tenants who are at least smaller or medium size, the building they're leasing from Dream Industrial is their flagship location that they're operating the essentials of their business out of, whether that's manufacturing or whether that's importing or whatnot. Like they need these assets, they need this real estate to operate their business given the size of the centers, or some of these are just massive companies as well. So I kind of like how so much of their rent is tied up in these large centers, really easy from a rent collection standpoint. And it's not like in retail where Starbucks can just shut 100 stores in a certain area. Right? This is their main thing. If they're not going to be using these buildings, they will likely not be in business or they may be shutting down. So I like how essential it is to their operations. It reminds me in some degree to Vici Properties and owning the casinos and the land under the casinos in Vegas. They get 100% rent collection because it's literally the most essential thing to those companies to be operating those locations. If they don't have those locations, they don't have a business. And I feel like to some degree, in some way, it's similar here with these large facilities that they're running their entire operations out of as well. Looking at their total debt to asset ratio here, we went through it on one of the prior slides with how they have lots of European denominated debt, but they're at about 35%. I think that's a pretty good level. Generally, I look for under 40% when I look at REITs, and over 40% is a bit more risky when you have interest rates going up and maybe vacancy rates ticking and stuff like that. I think 35% is a really fair level for a REIT in this environment, and especially one with solid history, solid fundamentals in a growth area like industrial. I feel really good about a 35% debt to asset ratio in terms of the amount of leverage they have on their balance sheet for industrial or for Dream Industrial. And then just longer term here, so you can see they've had really nice growth on their funds from operations, 7% FFO unit CAGR. So to compare versus some of my other REITs, it's stocks like RioCan, which is one of the best retail companies in Canada. They were doing about $2 funds from operations before the pandemic. They're going to do $1.80 this year. So they're not even back to where they were pre-pandemic. And then you got Dream Industrial here, who continues to grow their funds from operations at a pretty nice clip. So you can see the valuation difference because Dream Industrial here doing just under $1 a share in funds from operations in trailing 12 months. I think their forward looking is like 90 cents or something like that. So they're trading at about a 14 to 15 times funds from operations, let's call it. Whereas if you were to get RioCan today, it's about $18, $19, expected to do $1.80. So you're paying about a 10 and a half times funds from operations for RioCan. Some other REITs like Allied Properties in the office sector is about $20 a share, expected to do $2.20 funds from operations. So that one you're paying 9 times. So you got these office REITs trading in the high single digits, these retail REITs trading 10, 11, 12 times, and then industrial here, you're paying closer to 14, 15 times. But on industrial, you have stronger fundamentals. You have actual growth coming from rents, growth coming from funds from operations. So for me, as I look at my REIT exposure, I'm really heavy on retail right now. I have a good chunk in residential as well, but I don't have any industrial right now. And I think for 15 times funds from operations multiple is a fair valuation given, where interest rates are today, given the importance of this real estate and just the defensive nature of it relative to retail or office. So I actually think 15 times, I'm willing to pay that versus buying more retail or office at 10 times, knowing that this will be more defensive, less volatile, better chance of it growing over time in terms of my funds from operations per unit. And I'm also getting good European exposure. So that's the reason why I'm adding this industrial REIT to my portfolio. Just more diversification, getting a nice 5% plus starting yield. So it's not like it's extremely expensive or I'm paying for dividends that aren't going to come until 5 years from now or something. I'm still getting a starting yield over 5%. Just better fundamentals, paying a bit of a premium for it on the get-go here. Looking at some of the properties that this REIT owns here, you can see their GTA portfolio. So obviously lots of these places don't have a ton of assets like downtown Toronto and whatnot, just because they're very large centers, 100,000 plus square feet. But they're all on the outskirts of the GTA. These are really, really important assets for lots of the tenants that have them in order to bring product in or produce product and then sell it out to stores and customers around the GTA, whether that's direct to consumer or business to business. So you can see all out here in Oakville, they have a ton, up in Brampton, out in Oshawa, and they actually did a big acquisition of another public company called Summit Industrial. You can see Summit Industrial is all the blue dots on the page, whereas Dream is the orange. I think it's all one company now, so you're getting all these assets. They've already taken in that merger. That was a big part of their growth plan, and they got lots of scale from it. But I just wanted to show you guys, like flipping through some of these assets so you can get a sense of the type of real estate that is owned in this underlying stock here. So you can see here, this is one out in Markham, continuing to go through. They also have some opportunities for expansion. This is in Richmond Hill here, 154,000 square feet. I'm just going to go flip through quick just to give you guys a sense. This is in Vaughan. I'm going to shorten it a bit so you guys can get a better look. But lots of the times, these are like I said, the main facility that lots of companies import, export, and operate their business out of, which you can kind of just see by the scale and the sheer size of some of these assets. 280,000 square feet on this one in Guelph here, going a couple more down here. Another one in Guelph here, 200,000 square feet. Just scrolling through so you guys can get a look. You guys can pause if there's one particularly you want to see. 400,000 square feet here in Whitby, over 24 acres. They acquired it for 7% yield on cost, so pretty good starting yield on it. And you can just get a sense. Maybe not all of them are the newest properties you'll ever see in your life, but some of them, like this one here, over 400,000 in Etobicoke. That's really close to Toronto and downtown. This is probably a very valuable asset and charges a pretty high rent. Continuing to go through here, you guys get the sense. Going over to their European assets here. So you can see here where they have their assets. Over 50 assets in the Netherlands for over 7 million square feet. They have their 99% occupancy. France, they have over 3 million square feet, 100% occupancy. Some other countries with smaller presence, Spain, 1.3 million square feet, Czech Republic, 1 million square feet, Germany, 3.5 million square feet, all with pretty high occupancies, the lowest one being 97% there. So this does a great job of just diversifying away from just Canada, and I think they own a couple in the US, but primarily Canada in terms of where they have their assets. And in addition to that, these assets here give them exposure and ability to refinance debt over these properties in euro-denominated debt, which is significantly lower as we went through earlier on in the presentation. Just looking at some of the assets they have here, once again, we'll just go through this pretty quick. I think we have just some visuals here. So you can see some of these actually look a bit newer than the ones in Canada that we were going through, but very similar story just in terms of the size, the scale, the importance of lots of these facilities. I don't even know where lots of these cities are, but I imagine lots of them are in Netherlands. They're in the west end of Europe, seems like where they primarily are. But just huge facilities that they have across their business. These ones do look a lot newer and just more aesthetically pleasing. But just wanted to give you guys a sense for the underlying assets and what industrial distribution centers, light industrial, really mean. So just to wrap it up here, Dream Industrial trading at about 15 times earnings, paying me over 5% starting yield, and really helps me diversify my real estate holdings a bit away from retail, office, and residential, which I'm exclusively in right now. Think it's going to be a growth area moving forward. So even though I'm paying 15 times current funds from operations, I think 2, 3, 4 years from now, that funds from operations multiple will be lower versus the price I paid today. And I also like the fact that the net asset value on this one's closer to $17. So I'm getting a nice 20, 25% discount versus their kind of audited value today. Hope you guys like this video. If you like this kind of content, be sure to give this video a big thumbs up. Consider subscribing to the channel. Let me know what you think about Dream Industrial REIT or any other REITs or Canadian dividend stocks in the comments, and I'll see you guys in the next one. Thanks.